So to get into it, the first point was from an interview that you did with Corey Hofstein, and the overall lesson was beware of the risks that you can't see. So do you want to kind of flush that out and explain what you meant by that?
Sure. There's so many risks in investing that you have to take in order to achieve the returns you're trying to achieve. And what you want to avoid doing in investing is taking risks that you don't get compensated for. And Corey has taught me a lot about that there are a lot of risks out there that maybe many investors don't see, but they are taking, and that they're not actually receiving any compensation for taking those risks. And so the 5 questions I asked Corey were all around various risks that occur in investing that many people take, but they don't actually know they're taking them. And the primary one we talked about is the one called timing luck. And Corey actually had a paper published in, I think it was the Financial Analyst Journal or one of the major journals about this. And the concept of timing luck is the concept that when you rebalance your portfolio can actually have a major impact on your returns. So to use a simple example, if you run a 60-40 portfolio, 60% stocks, 40% bonds, and if in 2009 you rebalanced your portfolio in March versus if you rebalance it in September, you had a hugely different experience because the market went down. March was near the bottom. And so if you rebalanced back in March, you bought a bunch of stocks there, you brought up your stock allocation relative to bonds, and you benefited from the huge run in stocks that occurred in 2009. If you rebalanced in September, you didn't do that. You did not add to your stocks at the bottom, and you did not benefit as much from the ride back up. And so, and that's a risk you don't ever really make back. So whatever investors lost who rebalance in September aren't going to make that back in future years, most likely. So it's an important risk to understand that it exists. And we can talk a second. Corey has some options he talks about in terms of how you can deal with it.
Yeah. So, why don't how would an investor be able to mitigate some of that timing risk? What would some strategies be?
So Corey has some really complicated strategies he uses as a money manager, but the simple one most investors could use is just don't rebalance your entire portfolio at the same time. So going back to our 60-40 example, if I were to say I'm going to rebalance my portfolio quarterly and I'm going to rebalance 25% of the portfolio each quarter, well, I'm now mitigating that risk. So I could treat it as if, even though I have one portfolio, I could treat it as 4 different portfolios, one that rebalances each, during each quarter 4 times a year. And by doing that, I'm minimizing that risk because going back to our previous example, at least a portion of my portfolio would have been rebalanced at the beginning of 2009, and that portion would have benefited from the run in stocks for the rest of the year. And so by spreading out your rebalancing, you can manage that risk.